Hello and welcome to this 8IP webinar titled Prosperity Requires Innovation. My name is Alex King. I'm the Head of Distribution for 8 Investment Partners. Just to let you know, this webinar is being recorded. If you have any questions, please use the Q&A button at the bottom of the screen, and we will answer these questions at the end of the presentation. Speaking today, we have Stephen Walsh, Partner and CIO of the 8 Investment Partners Small Companies Fund. Welcome, Stephen.
Yeah, hi Alex, and thanks everybody for dialing in and giving us your time. I'll try to move through this in about 30-35 minutes, and then hopefully leave some time for questions at the end. I think we've got 45 minutes booked, so we'll try to keep to that. So if we can go to the first slide. Yeah. Okay, so just a brief introduction as to who we are. We're a specialist small companies business. We only do one thing, that's all we intend to do. We're entirely focused on that part of the market. We are an alpha generating manager, that's why we exist, that's our place in the world. And as such, we're currently managing 200 million with a capacity of around 800. And our intention is to limit our capacity going forward in order to preserve our ability to continue, hopefully, to outperform. We're majority owned by staff, which means that we're all aligned. All of our staff have the ability to buy equity, and all of our senior people are invested in our products. We have a team of 7 investment analysts, which is a reasonable sized team for this space. We're all pretty experienced with a total of 150 years of experience when you add it all up. We're based in both Brisbane and Sydney. In the past, people used to ask us whether that was an inconvenience in terms of communication. We actually think that it's an advantage. It means that we can be on the doorstep, as it were, in 2 different locations, which means as a group, we can be closer to clients and closer to the companies that we'd like to invest in. Most funds managers are described as being either value or growth. We don't think of ourselves like that. We think of ourselves as being essentially fundamental analysts, looking at companies in very fundamental ways. We like to think that we look at them from the top down. We focus on the big questions. Which industry are you in? How fast is the industry growing? And are you a great investment proposition? So go to the next slide, just to tell you a little bit about the people involved. So that's me on the top left, perhaps a younger incarnation on the top left. As Alex said, I'm the CIO of the business, which means that I'm the guy who sets the strategy and in the end has the final call on the stocks. I've done a couple of things in my career. I've been a management consultant for the first part of my career for 6 or 7 years. And that gave me a set of tools and an understanding as to how corporate strategy works, which is my passion and our focus. After that, I've spent 25 years now within markets, initially on the sell side. I was firstly a top-rated consumer analyst in Asia, ex-Japan, covering consumer stocks. I was then Macquarie's banks analyst for a period of time. And then in 2005, I joined Wilson's, which is one of the leading small cap specialist brokers. So I was head of research there and then head of capital markets. I made the switch to buy side at the end of 2012, and I've been here at 8IP ever since. Initially, I was the co-portfolio manager, and since then I've become the CIO of the small cap product. So as you can see, we've got, as I said, quite a large team. There's a lot of experience in there. Kerry Series is on the right-hand side. He founded the business back in 2009, 2010. He's now the CIO of the Inspire Impact Fund. And he helps us with ESG issues and investment ideas in that part of our universe. To my right is Sandy Grant and Vic Lee. They're the 2 other senior members of the team. Sandy was formerly the managing director of Wilson HTM, and Vic comes to us from Legg Mason. I'll just point out that Andrew Pedler there, he's our geologist. Myself, Sandy and Andrew all work together at Wilson's. And so we formed something of a core within the business, having worked together now for something like 15 years. Got 2 young and very clever analysts. And then we also set up an advisory board, the function of which is to assist us with thinking about our business, but also to think about the broad macro trends in the markets and how they impact on our investment decisions. And so that currently has 2 people on it, being Alan Moss, who probably needs no introduction, and Simon Barrett, who was the chairman of LEK Consulting, which is the consulting firm that I used to work for. So if we move forward, I'll try to run you through the core of our thinking and how we approach the issue of investment in small caps. The reason we exist, I mean, the reason that I do this, I mean, what makes us get up in the morning and what in my mind makes this such a great business to be in is that in the end, we're in the game of hunting for the really great businesses, the new really great businesses. And what that means is our ideal business creates products and services which are so different to those of their competitors that they materially beat them. And that can be for 2 reasons, either because the incumbents just can't keep up with the level of change, or because the products are so radical that they in themselves create brand new markets. So this we described as the doing something different. This doing something different means that businesses can create meaningful competitive advantage. And that's what we mean by innovation. You know, sometimes people mix up the concept of innovation with technology. And certainly technology is part of the story, and it's becoming more of the story as technology proliferates. But true innovation is not technology. It's a matter of strategy. It's a matter of making deliberate strategic moves which take advantage of competitors' weaknesses. Companies which sell truly innovative products offer their customers an alternative that's so compelling that they do 2 things. They take market share and they also retain control over their prices. And those 2 things, that ability to grow volume faster than others, but also potentially to raise prices, is the special combination that stock markets pay for. So we've attached the title of prosperity requires innovation. And clearly the ability to be innovative has always been a positive, but we actually think it's becoming an essential. And I say this for 3 reasons. I mean, firstly, if you think about the really big macro trends of the last 20 years that we've all, well, many of us have lived through, what are they? They're globalization, deregulation, the growth of India, the growth of China. These have produced a world which is, in many traditional spaces, simply drowning in overcapacity. This is well documented. It's not controversial. It's likely to continue to be the case for some time. Now, secondly, the price of capital has been coming down now ever since the GFC. And if it goes up soon, it won't go up very much. And so that means 2 things. Even companies with very heavy debt loads get to survive almost indefinitely. And it also means that anyone can find money for a new venture. These things surely mean that overcapacity will get worse. The third factor is that technology itself is making businesses more efficient. In undifferentiated companies, this ends up driving prices down. It adds, and that in itself adds to the competitive pressures already being created by the overcapacity that I've spoken to. So against that backdrop, we think that the rewards to innovators will rise. The requirement to be innovative becomes more and more important. And frankly, the damage done to the also-rans will accelerate. So what we do about all of this is essentially we do what other funds, small caps funds managers do. We hunt through lists of companies, but what we're doing is we're looking for true, sustainable, game-changing competitive advantage. Many businesses claim they have an advantage like this, and the reality is that most don't. At the same time, the ones that do tend to keep it hidden, which means it's actually quite difficult to find even when it's present. However, what we do is when we find that something special, the next step is to quantify it, to put it in our numbers and to value it. Also on the next slide, the key questions that we ask of each of our investments. So firstly, given that it's at the core of what we do, how special are the company's products or services? Do they have a competitive advantage that's sustainable? If they don't, we move on. Secondly, we're in the game of finding the best potential investments for our clients. So we need to assess how big is the opportunity. So what that means is essentially taking a view on the size of the forward revenue pool. And that means understanding the industry, understanding the size and the growth rate of the industry. The third piece is making an assessment of management. I like to say that it's very rare that you see a bad idea in the small cap space. And so what we're trying to do is to find the people who can make the opportunities happen. That's a question of an assessment of their competence and an assessment of the strategy that they're using. The fourth piece is coming to a clear understanding as to where each of these companies sits in regards to its own life cycle, its own evolution. This is largely a question of risk as much as it is opportunity. Ideally, what we want to do is to find those companies that are sitting early in their life cycle, but just at that point of acceleration where the business really takes off. That's at the point where you get most re-rating in the market and most upside for your investments. And which leads perfectly into our fifth question, the obvious question: what is the share price potential? I've spoken a lot about thematics. In the end, what we do is quantitative. And so we ask ourselves, do we have enough information to be able to process and come up with credible forecasts that we can have conviction in? If we don't, we move away. And what we're trying to do in the end is coming to a view as to whether each company can deliver revenue and EBITDA surprises versus consensus. In the end, markets are pretty efficient. We're looking for surprises. On the next slide, we talk about investing in three types of companies, therefore, and the headline names that we attach to those are stars, turnarounds, and under-researched. Stars and under-researched make up about 80% of our holdings, maybe 70 to 80%. Stars are companies which are beyond the startup stage. The competitive advantages they possess are clear. The impacts are being felt in the markets in which they operate. They're profitable. They tend to have a market cap of around 300 million. They face large, preferably global markets, not always global markets, but those markets are always growing faster than GDP. We value them based on multiples, primarily EBITDA multiples in this space. And we're investing in them because we think that there's an opportunity to make money over a period of time, look for about 20% per annum over several years. Examples of that in the past would include Appen, Altium, Breville. The under-research bucket, by definition, and the key thing about them is that they're earlier in their life cycle and they don't have much research. They look in many ways like the stars of the future, but they're meaningfully younger. They have low market shares. They may not be profitable. We'll go down to a market cap of about 25 million, we'll take those companies up to a market cap of around 300, 500 million. We need to be able to see a pathway to doubling our money in these stocks, otherwise we won't do them. And I'll talk about a couple of those later on. The final category is turnarounds. We find far few of these. They tend to be at the larger end of the spectrum. They make up about 10%, maybe 15% at times of our portfolio. We find more of them at certain types of the cycle, including at cyclical turning points. So there are a few available right now. Again, we look for a minimum 100% total return in these stocks. And examples include Eclipse and City Chic, both of which we currently hold. So if that's the theory, I might run you through the process that we use to select our stocks. So as an overview, we can invest in 2,000 listed stocks, much like most funds managers. in the end, we use a series of screening techniques to get that number down to an active universe of about 150, so between 100 and 150 stocks. We then apply 3 sets of tools to discover whether we want to hold those companies: quantitative, qualitative, and ESG most recently. In addition, we use the services of certain external providers. I mentioned 2 in particular: Alpine Macro, which is a US-based macroeconomic boutique. We've been using them I've been using them since about 2007, and they're excellent. And the second external supplier that we use is a group called Coleman. So Coleman Research is a business network which enables us to contact experts in certain industries or companies anywhere around the world. And so as we get deeper into our fundamental research, sometimes we feel the need to speak to people with a greater degree of insight. We'll call Coleman and they'll set up interviews with people who can help us. At the far end of the process, the end of the process, once we've gathered all our research and got our views, we'll discuss whether we want to hold the companies. That happens within our investment committee. And typically 40 to 60 stocks will make it through to the portfolio. As I said, at the end of the day, I'm the guy who has the call on the stocks. Just a bit more detail on the next slide is around idea generation. So, you know, how we move from that 2000 down to the 150. The first stage is pretty easy. We do a pre-screen process, which is based on market cap, liquidity, and sector. That takes out 1,200, 1,300 companies, really on the basis of size. And then we take the remaining 700 and we do 2 sets of screens, one for stars and under researched and one for turnarounds. In stars and under research, we are searching for the sorts of characteristics that we think should exist in the sort of companies that we're looking for. So we screen for sales growth, a minimum of 7.5%. We screen for margin expansion, which is a sign of leverage. And then we're looking for improving return on equity, which implies disciplined capital allocation. On the turnaround side, our screening is much simpler. We essentially screen for share price declines, note the companies where that has occurred, and chalk them down as potential turnaround opportunities. Out of the filtering process, that tends to lead to about 100, 120 companies. And then at any one time, of course, we're also working in markets. We have very broad networks, including brokers and multiple personal contacts, which give us ideas. And so all of those combined give us our active universe. So as we've got them, we apply our research processes, and the research processes are somewhat templated to the different types of stocks that we're looking for. I think that's quite an important process point. I mean, we are trying to look at a very large number of companies, and so we need to have frameworks in our head which tell us the sort of characteristics that we're looking at. We need to spot our companies quickly, and we need to move to conclusion quickly. And so that's why we template these research processes. I've spoken quite a bit on the qualitative side in terms of what we look for in the stars and the turnarounds. Validation, the point at the bottom, means that we cross-check our theses against the real world as much as we can. We talk to competitors, we talk to analysts, of course, we talk to independent experts. And the example of independent experts might be a senior manager who's worked in the company in the past, for example, and we'll source those through Coleman. On the quant side, the numbers side, and I want to emphasize that this is, as I've said, as important as the qualitative factors. And in the end, investment is a numbers game. So it's probably more important, in fact. And in the end, everything we do is driven by the numbers. You know, that point about fit, is it amenable to our analysis? If we can't get the data, we'll just pass. You know, we need to be able to develop conviction, and it's all around the numbers that we can analyze. Our focus in stars is on levers. How many levers does each company have to enable it to grow. The sort of things that I'm talking about there are, what is the volume growth potential? Is there any pricing power? What segments are they in? Do they have the ability to put out new products into new segments? Are they an acquirer? Those sorts of things. The more levers, the better, in fact, because it gives you more optionality and security over revenue growth. We're looking for EBITDA surprise, and we're looking for multiple expansion. Those are the two key factors which drive share prices. Our valuations they're always multiples based. We don't use DCFs, even in long tail companies. We sort of insist on ensuring that valuations over an appropriate time frame make sense from a multiples perspective. The next slide is about, goes through our process in respect of under research stocks. So of course, these are earlier in their life cycle, they're lower liquidity, they're therefore a higher risk. And so the processes that we apply here are designed to lower that risk. And so there's three of them. I mean, the first is we want the simple stories. We don't want to get involved in stories that are too complex. And so we want businesses which are focused. They're monoline businesses. They only do one thing. They allow management to focus on the really critical issues. But we don't want to spend too much time trying to work out whether a company has a competitive advantage. We want it to be self-evident. And the third piece is we want, as far as possible, for these markets, for these companies to be involved in global markets, so that the size of the opportunity is big. The next piece is we want to be dealing with companies where we have deep experience within our team. So we want to be able to leverage our strengths. So within our team, we do have particular sector strengths. As a sell-side analyst, and therefore for 25 years, I've been covering finance and consumer companies, so I lead on those. We've developed a real insight and understanding of technology over the last few years in 8IP, and so we do focus on tech. Andrew, as I said, is a geologist. He's been a geologist for nearly 40 years now. Geologists are surprisingly rare in the Australian market, and so he's really helpful to us with early stage resources stocks. Vic's a property expert, etc. You can't get away from the third point, which is man hours in this space. The point about under research stocks is that you do have to work pretty hard to understand the detail because they're under research, so you have less help in doing it. The right-hand side of that slide sort of tries to explain what we're trying to do in terms of getting to a level of conviction on these sorts of stocks that we buy. A nice thing about early stage stocks is that they map out their desired pathway, and so they provide you with operational milestones. Where they don't, we ask them for those milestones, and we set up an expected pathway, in particular to revenue growth, which we can track throughout the evolution process of the company and of the stock price. As I said earlier, we're looking in this part of the market to double our money. The next slide just sort of underlines the opportunity set in this space. So what I've done here is I've simply looked at the number of sell-side analysts per stock according to the size of the company. So on the top chart, you can see that for each top 100 company, there are roughly 13 analysts per stock. And that declines in a linear fashion, such that by the time you get down to number 400, company number 400 in the index, there's on average 2 analysts covering per stock. And that's a very similar picture in our portfolio. The stocks that we hold in the small ords, on average, there are about 7 analysts. But outside the small ords, it drops to 2, and for many, it's 0. The next slide talks about turnarounds. Just sort of quickly moving through this, the ideas come from the same place, screens, and what we do need to see is we need to see evidence that there's a trigger to get involved. So we're looking for management change and a plan. On the qualitative side, we want to understand the business. We want to understand the discontinuity. We understand the discontinuity being, what's gone wrong? Can it be fixed? Is there more downside? We want to understand how complex the fix is. We don't want the complex ones. We just want the easy part first. And then on timing, we don't want to try to pick the bottom. We want to wait until we can see the sign of change. On the quant side, our models are different here. We focus on the typical steps that are required to turn a company around. And we look for 4 of those. We look for asset sales, the repayment and the restructuring of debt, the cutting of costs, and in the final stage, growing of revenue. We value these based on the step changes in earnings and multiples, which come from enacting those turnaround plans. And that allows us to build our pathway for the business and for the share price. So on the next stage, just quickly on ESG, I mentioned we have 3 tools, quant, qualitative, and ESG. On ESG, we've developed our own methodology, which is shown there on the slide. We derive a stock from our own work, which is described on the left-hand side. We start with 1 score, which is purely quantitative, and our work is purely quantitative in part 1, and the second part includes quite a detailed engagement program with the individual companies so that we understand the issues that they face from an ESG perspective and also how they are planning to overcome them. That also drives out a score, and we combine those 2 scores to give us a 50% numerate weighting. We combine our process with Sustainalytics, which is one of the 2 sort of global suppliers of ESG research. They've been doing this for 30 years rather. And so we want to leverage on their expertise. In the end, what happens is that we drive out a final ESG score for each stock, and that ESG score feeds into our process and is one of the factors which dictates the ultimate maximum allowable weighting in the portfolio. On the portfolio construction piece, once we have all of that information, we rank the stocks according to the total expected return and our conviction, set the target rate and think about how it fits in the portfolio. Our conviction levels are shown there on the bottom left-hand side, and the rules, disciplines that we apply are shown on the right-hand side. The ones that are possibly worth calling out are the liquidity-based rules. Obviously, liquidity is a massive issue in small caps. For us, a maximum of 30% of the portfolio can be invested outside the small cap index, and a maximum 30% of the portfolio can be in illiquid stocks, which we describe as stocks which would take more than 30 days to sell, assuming a certain market share of trading. Once we have the portfolio, next slide sort of talks briefly about how we manage our positions. We, on an ongoing basis, this concept of the pathway is critical. We're always watching to see how the companies progress against that expected pathway. And we'll sell stocks when they hit price targets, when there's an unexpected negative, when we've got a better idea. But also we're constantly looking at them for signs in particular of slowing revenue or margin growth. And we're very active in markets, we'll add in capital raisings, we do trade volatility, and of course we'll add more if there's an unexpected positive. Just a quick run through a few stocks to sort of try and hopefully make that real. So we acquired Split It in January of 2019. It IPO'd at 20 cents. We were actually the largest, we actually received the largest allocation to Split It at the IPO stage. And we still hold it today. Clearly it's done very well. It's trading around 150 cents, 150 at the moment. What they do is they provide the holders of Visa and MasterCard credit cards with the ability to split payments according to installments. So it looks a little bit like buy now, pay later, but the customer base is completely different. It's higher quality, it's wealthier, more affluent, and of course the credit comes from the credit card companies, so the exposure to debt, the exposure to bad debt risk is materially lower. This is a massive opportunity. There are 1.1 billion credit card holders in the world, and there's potential application of this installment-based product not just to retail, but also to business payments. The business has a material competitive advantage. It was the first mover. It's got patented IP. The people who manage it are very credible. The chairman is ex-National Australia Bank. The CEO is ex-PayPal. Very impressive senior executive team. And so they're very well placed to take market share in this space. The interesting thing about this company is that there's multiple levers. We're still in the very early stages of the life cycle. Merchant sign-up rates are accelerating. There's associated very strong growth in shoppers. Average order value is growing very quickly. And of course, post-COVID, the move to online retail is accelerating. And probably we're looking at the next 2 months, which will be extremely strong. So we're still very positive on Split. Just by comparison, Afterpay has a market cap of $29 billion. Split is by far and away the least expensive of the buy now, pay later, if you like, sorts of stocks, with a market cap of $600 million and on the point of material acceleration. Let's talk quickly about City Chic on the next slide. So City Chic, different type of opportunity. We acquired it initially as a turnaround when it was spun out from specialty fashion, which was an underperforming, let's say, retail conglomerate. So it was sitting in there, essentially being lost, really, being underinvested in. The business was spun out and suddenly became a monoline, led by fantastic management and with a special focus on the online space. So its business has changed itself and it's now 65% online. They target what we describe as the underserved global market for plus size women's fashion, demographic 18 to 35. Their competitive advantage is they simply understand cuts better than anybody else. And following a series of acquisitions, they now have more cuts in this part of the market than any other retailer globally. These guys are excellent retailers. They're highly focused. They've got really disciplined approaches to capital deployment. It's trading at a reasonable PE, low 20s ex cash at the moment. And we think that's a multi-year opportunity. Our 12-month price target is above $4 and it's trading probably mid-2s at the moment. I might skip through the next slide just in the interest of time and go to performance, Alex. Thanks. So we've been doing this for 8 years. This is actually 8 years exactly now. So our performance record dates to October 2012. Nothing has changed in the process over that time, and you can see the numbers there. So we've outperformed by a compound 6% per annum over that time period. Another way to look at it is we've done 11.6% net since inception. The market's done about 5.6. So we're obviously pleased with that outcome. We think this validates the process that we've outlined and used over that time period. I'll just talk a little bit about what's happened in 2020 and how we've responded. We did have a bad March, but critically, the fund has accelerated much faster out of the downturn. And we think that that's because of the actions that we took, when this very large event occurred. We had a 4-point response. We rethought how we thought about stocks. We increased quality. We bought more gold. And we bought more stocks. In the period between the end of March and the end of July, the portfolio performed extremely well as a consequence of those moves. We think we're now in a sort of different stage. We're in the recovery stage where investors want to rotate into cyclical stocks, but sort of waiting for that coincidence of correct or appropriate macro indicators to suggest that it is the right time to do it. Our portfolio now is somewhat more, it's positioned towards growth, cyclicals, and we still have a lot of gold in anticipation of inflation. The next slide shows the contributors to performance over 3 and 1 years. Given the comments I've made, and again, it's pleasing that the best sources of outperformance have been the sorts of stocks which have the characteristics that we're really focused on finding. Over the last year, our most negative contributors have been Credit Corp and in particular an Eclipse, which were really what we describe as COVID epicenter stocks. They really suffered badly. We were not in Fisher and Paykel, well, not overweight. We were in Fisher and Paykel, in fact. Mineral Resources, it was a miss, and Clover Corp still performing, but it's just taking longer than we expected. To finish off, sorts of stocks that are in our top 10 are shown on the next slide. The average weight's about 3% of this of these stocks. There's a lot of diversity by sector, which hopefully you can see. We've got a lot of focus on innovation, but 3 of them are tech, no more than 3. A lot of these companies actually have quite defensive revenue streams, so it's worth saying we're not taking outsized bets on high octane early stage opportunities. We're definitively not trying to do that. 5 of these stocks are ex-benchmark. Hopefully many of them are stocks you haven't heard of particularly. We've taken profits on most of these actually over time, but we still expect that they can go further into the future. And then maybe moving to the final slide, just on diversification. So again, hopefully you can see here that, we're not hugging the benchmark. We think a lot about what we own. We're definitely active managers. During the COVID period, we've really reinforced our focus on liquidity. We've got a weighting of around 10% of stocks requiring more than 30 days to liquidate. That's reasonably low for us. We normally go up to about 15%. We're keeping a very close eye on that. We're currently actually a little bit higher right now in cash than is shown on that slide. We're closer to our maximum, which is 10%. There are 60 stocks in the portfolio at the moment. Top 10 is about 30%. Top 20 is about 50. In more stable macro environments, we'd probably hold between 45 and 50 stocks. So hopefully that's a quick whip through what we do, and I'll hand it back to Alex.
Thanks, Steve. If anyone's got any questions, please feel free to use the Q&A button and flick them through. I haven't seen anything at this stage, so feel free to work those through. A couple of questions from me. I think obviously the process and the team work quite well together, Steve, and I guess a good question from that perspective is, who makes the ultimate decision on stocks being added? Obviously the work gets done by the analysts or whoever is particularly the specialist in the space, but how does the decision eventually get made?
Yeah, thanks, Alex. So look, we're very fundamental. We place a lot of emphasis on detailed work. The discussions around stock allocations are held within the investment committee, which is that group of sort of senior people that I pointed to earlier. And what we want to do is to get to agreement. And we want to do that because agreement is the best way of indicating that conviction is really there. If we don't initially get to agreement and excitement about the individual stocks, basically my role is to decide what to do next. And very frequently I will say, right, go and do more work. Let's just sort this out. Let's go and do more work. See if we can get to where we want to get to. If at the end of the day we do that and we can't get to levels of conviction, we will throw it out. not go there. In the end, I have the right, and do occasionally do this, to simply say, I'm there, and we'll take those stocks. So in the end, it's my decision, but I'm very keen on creating a positive working environment, which means a consensual outcome.
Great, thanks. Now we've got a couple of questions. I'll go first to how do you think about ESG when it comes to resources stocks?
Yeah, so we are not primarily an ESG fund. We think that ESG is about, we think it's an investment risk that we need to be aware of, and clearly it's an increasing investment risk with respect to how people are looking at the market. We don't think that it's our job to exclude entire sets of industries from our universe, and so what we do is twofold. We do two things. We try to understand the specific sets of risks that face resources companies, and we do that in particular with the help of Sustainalytics, whose research is very deep, very detailed, and very sector specific. And the second thing we do through our engagement process is we want to talk to the companies about how they are dealing with the cards with which they've been dealt. And our interest there is not just to look backwards, but to look forwards. In the end, the scores that we assign to each stock tend to come out more negatively in respect of resources stocks, but that doesn't mean that we don't invest in resources. Clearly we do. But what it does mean is that in some cases the maximum allowable weight is negatively impacted. However, interestingly, in the stocks that we do hold, there has not yet been a case where we've been forced to reduce our weight in resources stocks, which I think is quite a good outcome, because it sort of says to me that for other reasons, we've got to a weighting with which we're comfortable in the resources space and in particular stocks. However, we won't invest in resources stocks with specific noted high risks and a history of bad behaviour. We just won't do it. And I should say we don't invest in coal.
Great, thanks. Now there's a question here on platforms which I might just quickly answer, because it's a good question. The fund is currently on Hub24. It's also available through NetWealth as a private label. We are fairly early days with, I guess, the sort of the retail wholesale strategy, which I might let Steve talk to in a moment. There's about $220 million that the team manages, the bulk of which is institutional mandates. So at the moment we're on those two platforms. We are working to increase that, and are hoping, obviously the platforms do demand a level of interest within a strategy. So we're working with a number of groups to try and work out which platforms we will be adding ourselves to. Macquarie is quite high on the list, and if you have any interest in specific platforms, please let us know. Steve, do you want to maybe talk about the I guess the last 8 years and the fund, as far as the mandates that you're managing, and where you're at with the actual sort of the more retail type strategy?
Yeah, sure, Alex. Yeah, thanks. So, I mean, we've sort of existed really as an insto business from the start, really. I mean, the retail, the advisor market offering has been there from the start, but we haven't really focused on growing it, and I guess that's what we'd like to do now. Now, Alex is a great hire for us. Alex has been with us for 2 months or so. He's already forced me to get up in front of a camera. Our objective is, we think we've got 800 million of capacity. Our objective is to carve out allocations on, hopefully it would be 50-50 over time. But, You know, we're very keen to grow the business. We're very keen to diversify the business. And hopefully now that I've been in front of the camera once, I shall do it again. And hopefully you'll hear from us both more regularly.
Thanks, Steve. We might wrap it up there. So thank you for you know, unique insights into the way you guys think about innovation and actually putting that into the process and managing the strategy with that in mind. I think the performance of the fund over time certainly shows that there's a level of consistency within the process that works very well, and the strategy has performed very well based on that. I'd like to thank everyone for joining us today. I will be forwarding you a copy of the webinar. As I said, we've recorded it, so you'll receive a copy of the webinar and the presentation, and I'll be in touch. But if you have any questions in the meantime, please feel free to let me know. Thank you.
Thanks, everyone. Thank you.